Tuesday's inflation print showed a continued deceleration in prices, but that core figure remains sticky. The question on everyone's mind, can the economy stay resilient, or are we headed towards an economic crash? Joining us now is Nouriel Roubini, NYU Professor Emeritus for the Stern School of Business. So let's get right into this. Are we headed towards a crash? What's your outlook?
Well, if we define it by crash, economic downturn, a hard landing, I would say that the probability of a hard landing, meaning at least 2 consecutive quarters of negative economic growth, are higher than the one of a pure soft landing. The economy is slowing down. The Fed is raised rates, and in my view, they'll have to raise them more because inflation is still too high, both wage inflation and core. They'll take a pause, of course, in June, but might need to raise rates more in July and September. Credit growth is tightening because of the problems of the regional banks. The forward-looking indicator of economic activity, both for manufacturing and services, are entering a contractionary direction. The labor market is still creating jobs, but there are signs of a softening of the labor market. And also consumption growth is slowing down. Growth in the first quarter of the year was below potential at 1.3. In the second quarter, it might not be much better. And globally, the Eurozone is already in a recession, 2 quarters of negative growth in Q4 and Q1. And now there is a sharp slowdown of growth also in China that doesn't bode well for U.S. exports. So my baseline is still one of a recession as opposed to a soft landing, yes.
From what we've heard during the earnings season, bank CEOs, they're looking for a Q3 2023 recession. Do you believe that that timing, from your estimation, from your calculus, is accurate, or are we looking for something a little bit more drawn out or pushed out?
We don't know yet. I think it's going to depend on several factors. One, how much of this credit crunch is going to reduce credit growth already this year as opposed to pushed into 2024. The Fed is going to pause for the time being. That's good for risky assets and bond yields, but they may have to resume hikes as early as July or September, in my view, at least a couple of more ones, and that's going to lead to further concerns about the economy. And then there is the global geopolitical situation that is not great. If this war between Russia and Ukraine gets worse, commodity prices are going to go higher. The Cold War between U.S. and China is getting colder, and there will be economic, financial, and technological retaliation. The whole bunch of risks in the Middle East, including the risk that Israel is going to strike Iran. So there are lots of things that could lead to a spike in commodity prices. That could also be the factor that pushes us into a recession.
So, Nouriel, I got to ask you, so your colleague, Jeremy Siegel, has talked about kind of his kind of 3 points recently about 3 expectations he has. So largely in general, the expectation is for a pause to Jay. He is expecting that the Fed won't hike throughout this year. So there's some divergence in your viewpoints. He is still expecting a recession, but predicting it will be a mild one. Do you share that same prediction?
Well, I do believe that the Fed will pause, but then will have to raise rates more because they're going to change their forecast about core PC inflation. By year end is going to be closer to 4% than 3%. And therefore, staying at 5.25 is not sufficient. The impact of the credit crunch on credit condition is still ongoing and is going to become, in my view, worse. There are problems, as we know, in some parts of housing and commercial real estate. So certainly there is going to be a recession. Whether that recession is going to be short and shallow as opposed to more severe depends on many factors. How much persistence of wage and price inflation, how much global factors that are going to be negative, what's going to happen to commodity prices, to geopolitical factors, and further tightening of financial conditions.
Nouriel, what we've continued to try and gauge is where corporations are playing a role in the current wave of inflation that we're at right now. And we've heard a new term from many come about called excuseflation, or what some economists would less colloquially perhaps call profit-led inflation. To what extent are corporations kind of continuing to hold up us getting past some of the lingering inflation right now?
Well, there is some evidence that because there has been a greater amount of concentration and oligopolies in many parts of the corporate sector, that corporates have, first of all, pricing power. Secondly, there has been a rising cost, wage cost and intermediate inputs and commodities, but some corporations have taken that one as an excuse for increasing prices even in excess of their cost. And therefore, that the widening of profit margin, paradoxically, is a signal that the inflationary pressure remains, because if then prices rise more than cost, there's more pressure from workers to have greater wage increases to compensate for the squeeze in the real wages. So there are many factors, of course, that have led to the rise in inflation. One of them is oligopolies and concentration and pricing power of the corporate sector. It's not the key one, but it is a factor.